Imagine holding a $1.65 billion check in your hands.
That is a lot of money.
Right. A massive 10-figure payday generated in just 90 days. Now imagine that roughly 72% of that money came from a device so incredibly small that it can literally be threaded through an artery in a patient's leg,
Yeah.
pushed all the way up into a beating human heart, and deployed to literally save their life.
It's pretty incredible to think about.
It really is. So today, you and I are going on a deep dive into a brand new, incredibly dense financial document that just dropped yesterday on April 23, 2026. We are exploring the Q1 2026 earnings report from Edwards Lifesciences.
Yeah, and if you follow the medical tech space, you probably recognize their logo.
Oh, yeah, that distinct stylized E layered over those overlapping geometric spheres.
Exactly. They are the leading global structural heart innovation company.
And our mission today is to, well, cut through all the corporate jargon and translate these massive financial numbers into the actual technological leaps that they represent.
Because the stakes underlying this financial report are, they're profound. We are looking at data that tracks human heartbeats just as much as it tracks dollars.
Yeah, that's a great point.
Like, these numbers aren't driven by consumer demand for the latest smartphone or, a luxury vehicle. They are driven by urgent, complex, and genuinely life-threatening patient needs.
Right.
When someone requires a heart valve repaired or completely replaced, that is a critical, highly time-sensitive intervention.
Okay.
And that fundamental, undeniable human need is the direct fuel for the massive financial engine we are about to break down.
Okay, let's unpack this, starting with the macro view. Because before we get into the actual mechanics of these medical devices and how they function inside the body, we really need to understand the sheer scale of the company's financial momentum in the first quarter of 2026.
Yeah, it's massive.
Because you don't just, stumble into a $1.65 billion quarter without a very specific catalyst.
No, absolutely not. And that top-line number is just a formidable starting point. Total sales for Q1 hitting $1.65 billion. That represents a reported growth of 16.7% compared to the previous year.
Which is huge.
Oh, to give that some context, for a company of this immense size, double-digit growth is incredibly difficult to achieve.
Right.
Now, the report also highlights their growth on a constant currency basis, which came in at a very robust 12.7%.
Okay, wait, constant currency. Why does that matter here?
So this metric is vital because it strips out the noise of fluctuating global exchange rates.
Oh, I see.
Yeah, when a company operates worldwide, a strong U.S. dollar can actually make foreign sales look artificially lower on paper. So the 12.7% figure shows us the true operational velocity of their products moving off the shelves and into operating rooms, regardless of what the currency markets are doing.
Got it. Okay, that makes sense. We also have to look at their profitability, though. Their earnings per share, or EPS, came in at 66 cents with an adjusted EPS of 78 cents an ounce. And the CEO, Bernard Zovighian, pointed out that this quarter's strong performance reflects a highly focused corporate strategy. But digging into the report, there is a detail that literally made me stop and reread the paragraph.
I think I know which one you're talking about.
Yeah, Edwards is so confident in their current trajectory that they actually raised their full year 2026 sales growth guidance. They bumped it up from an initial estimate of 8 to 10% all the way up to 9 to 11%.
Yeah, that's a big deal.
They are predicting total company sales to reach somewhere between $6.5 and $6.9 billion for the year. I mean, raising guidance is always a bold move because you are essentially setting a new higher bar that the entire financial market will hold you to.
Exactly. It
Yeah.
creates a completely self-imposed pressure test. You only raise guidance if your internal metrics are flashing bright green across the board.
Which leads to a crucial question, I think. Is it normal to be this aggressively optimistic in Q1? We're only 3 months into the calendar year. So for a company to confidently promise nearly $7 billion by December, did something in their pipeline wildly exceed expectations, or is this just, a very aggressive posture?
What's fascinating here is that this confidence is backed by tangible, massive financial action. It's not just corporate posturing for the shareholders.
Oh, really?
Yeah. During this exact same first quarter, Edwards completed a $500 million accelerated share repurchase.
Wait, meaning they bought back $500 million of their own stock from the open market?
Exactly. A stock buyback of this sheer magnitude, combined with raising sales guidance in Q1, it's the corporate equivalent of a baseball player calling their shot in the first inning.
Right, like pointing at the bleachers.
Yes, they aren't just saying they have a strong portfolio, they are putting $500 million in cash on the table to prove it.
Mhm.
It is a massive signal to the market. It tells us that their internal forecasting, looking at their clinical trial data, their regulatory approvals, and their hospital contracts, it's so strong that they believe buying their own stock is the absolute best return on investment they can make with that $500 million.
So what does this all mean? How are they actually generating that $1.65 billion in just 3 months? To figure that out, we really have to transition from the overall balance sheet to the absolute core engine of their business,
Yeah.
the device that is literally funding this entire operation. And that engine is a technology called TAVR.
Right. TAVR, which stands for transcatheter aortic valve replacement.
Yeah.
In Q1, TVR sales alone accounted for $1.2 billion.
Out of the $1.65 billion total.
Yes.
So roughly 72% of their entire Q1 revenue is coming from the single therapeutic area.
It is the undisputed heavyweight of their portfolio, and the report indicates that their global average selling prices for these valves remain stable, which is just excellent news for their profit margins. But the really compelling story is the geographic distribution of that growth. While their U.S. growth was undeniably healthy, the growth outside the U.S. actually outpaced it.
Oh, interesting.
Japan, in particular, was a major catalyst. This was driven heavily by the rapid adoption of their SAPIEN 3 Ultra Resilia platform in that specific market.
You know, to really grasp what this means, I like to picture the aortic valve like the main water shutoff valve in your house's plumbing.
Okay, I like that analogy.
Yeah, like if that valve gets stiff, severely calcified, and simply can't open properly, a clinical condition known as severe aortic stenosis, your heart has to pump furiously just to push a normal amount of blood through a tiny restricted opening.
It's completely exhausting for the cardiovascular system.
Exactly. And historically, fixing that plumbing required cracking the patient's chest open, stopping the heart entirely, and performing open heart surgery.
Right, highly invasive.
But what makes TAVR revolutionary is that doctors can thread a brand new, completely collapsed valve up through the femoral artery in the leg, navigate it into the beating heart, and deploy it entirely inside the old, failing valve.
Yeah.
It literally crushes the old calcified leaflets out of the way and just takes over the job instantly. It is structural engineering happening inside a beating human heart.
It completely transformed cardiovascular medicine. And looking at the market dynamics in the report, Edwards' global competitive position in this TAVR space actually increased year over year.
Wow.
However, the report specifically notes that a significant portion of this market share gain in Europe was due to the exit of a major competitor.
Wait, I have to push back on that narrative for a second. A major medical competitor just packs up their bags and abandons the European market.
Yeah, pretty much.
Does that mean Edwards is dominating because their technology is objectively superior? Or are they just winning by default because the other guy threw in the towel?
Well, if we connect this to the bigger picture, it is far more complex than just winning by default. Picking up market share from a departing competitor certainly provides a favorable short-term tailwind. But the actual sustainable driver for TAVI's 14.4% underlying growth rate isn't just playing musical chairs with market share.
Right.
The real driver is a tectonic clinical shift in how doctors fundamentally treat this disease. And that shift is driven by brand new data. Specifically, the report heavily emphasizes the early TAVR study.
Let's look closer at that study because the implications there seem massive.
They are. The early TAVR study is pushing the entire global medical community toward proactive disease management.
Okay, what does that mean in practice?
Traditionally, standard medical practice dictated that you monitor a patient with severe aortic stenosis, but you wait until they show severe undeniable physical symptoms.
Like what?
Like fainting or extreme shortness of breath. You'd wait for that before you perform a major valve replacement. But the data coming out of these recent studies is encouraging cardiologists to evaluate and intentionally refer patients for TAVR intervention much earlier in the disease pathway, even if the patient is currently asymptomatic.
So fixing the plumbing before the pipe actually bursts rather than waiting for the basement to flood?
That is the exact mechanism of this shift, and it's being supported at the absolute highest institutional levels.
Really?
Oh, yeah. The European Society of Cardiology, alongside the European Association for Cardiothoracic Surgery, have recently updated their official clinical guidelines to reflect this proactive approach.
Wow.
And when you change the official guidelines, you immediately expand the overall pool of patients who are eligible for the procedure. Furthermore, the report notes that in the U.S., the Centers for Medicare and Medicaid Services, CMS, is currently reconsidering the national coverage determination for TAVR.
Which dictates the financial reality of who actually gets reimbursed for the procedure. Because if CMS won't pay for it, most patients simply cannot access it.
Exactly. That financial risk model dictates medical reality. If CMS expands coverage based on this early intervention data, it drastically improves timely patient access across the United States.
That makes total sense.
So, to answer your earlier point, a competitor leaving Europe is merely a footnote. The real growth story is the entire global medical establishment shifting toward earlier intervention, which effectively widens the total addressable market for Edwards' flagship product.
Okay, that makes the $1.2 billion figure make a lot more sense. The pie itself is expanding.
Right.
But since TAVR is already the established giant, we have to look at where Edwards is placing its bets for future growth, because a multi-billion-dollar company cannot survive on just one product category forever. I mean, markets eventually saturate.
They absolutely do.
This takes us away from the aortic valve and moves us to the other vital doors in the heart, the mitral and tricuspid valves.
Yes. This brings us to their TMTT segment, transcatheter mitral and tricuspid therapies. In Q1, this division brought in $173 million. Now, compared to the $1.2 billion of TAVR, it might look like a smaller piece of the pie. But globally, the total number of clinical procedures for mitral and tricuspid diseases is growing in the double digits, and Edwards is actually growing their revenue in this space even faster than the broader market average.
See, reading through the section of the earnings report, you suddenly find yourself drowning in an absolute alphabet soup of medical acronyms and brand names.
Oh, it gets intense.
We got TMTT, TMTTR, SAC, Sapien M3, Evoke, Pascal. Can you break this down? Why does Edwards need so many wildly different platforms if the goal is ultimately just to fix a heart valve?
It can absolutely feel overwhelming to read through that pipeline. But the core reason for this massive variety is that patients are not one-size-fits-all, and the anatomy of these specific valves is incredibly complex.
Okay.
The mitral valve has 2 leaflets, while the tricuspid valve has 3. Sometimes a patient's valve is basically functional, but it has become a little floppy and leaky, allowing blood to flow backward. That patient doesn't need the valve entirely removed, they just need a mechanical tune-up. And that is where a therapy like Pascal comes in.
Okay.
Pascal utilizes a technology called TEER, transcatheter edge-to-edge repair. Imagine a tiny, highly engineered mechanical clip that grabs the floppy edges of the natural valve and fastens them together so the valve can close tightly again.
So a platform like Pascal is entirely focused on mechanical repair.
Correct. But then you have patients whose natural valves are simply too degraded, calcified, or damaged for a simple clip to be effective. The entire structure needs to be replaced.
Right.
That is where you utilize therapies like EVO-Key or the newly FDA-approved Sapien M3 platform. These are full structural replacements, functioning similarly to TAVR, but designed for the unique shapes of the mitral and tricuspid spaces.
Got it.
And the clinical data supporting these different approaches is currently driving immense physician enthusiasm. For example, at the recent American College of Cardiology Scientific Session, the ACC, researchers presented 2-year data from the TRISCEND II trial.
Okay, what did that show?
This pivotal data showed that using the EVO-Q therapy resulted in significantly lower all-cause mortality for patients suffering from severe tricuspid regurgitation.
And the tricuspid valve has historically been incredibly difficult to treat safely, right?
Very difficult.
So seeing data that shows lower all-cause mortality is just a massive win.
Yep.
They also mentioned launching a next-generation version of the Pascal repair technology in Q4 for both the US and Europe. It seems like their underlying strategy is to build a comprehensive, specialized toolkit for cardiovascular surgeons.
Exactly.
Like, depending on the exact geometry of a patient's failing heart, Edwards wants to ensure the surgeon has a bespoke tool, whether it's an EVO replacement or a Pascal repair clip just ready to deploy.
A comprehensive toolkit is the ultimate goal. And we cannot overlook their traditional surgical segment, which brought in $276 million this quarter, growing at a very healthy 10.1%.
That's still a big chunk of change.
It is. While these transcatheters minimally invasive procedures are the high-velocity growth drivers, traditional open-heart surgical valves remain absolutely critical for certain complex patient anatomies.
Right, of course.
Edwards is preparing to release 10-year data from their COMMENCE trial soon, which is vital because it tracks the long-term structural durability of their proprietary Recilia tissue used in these surgical valves.
Wow, 10 years.
Yeah, tissue valves naturally degrade over time, so proving they can last over a decade is a major selling point to hospitals.
The pipeline is just relentless. They also mentioned launching a dedicated surgical tricuspid valve called Triformis in the second half of 2026.
Yeah.
And they have a left atrial appendage closure, or LAC, program, getting a preliminary introduction later this year. It is a sprawling, wildly ambitious portfolio of biological innovation.
It really is.
But building out this vast array of bespoke, cutting-edge technology requires a staggering amount of capital, which means we need to shift our focus from the clinical achievements in the operating room to the stark mathematical realities of the balance sheet. Let's look under the financial hood.
Let's do it. Designing, testing, and manufacturing these life-saving tools is one of the most capital-intensive endeavors in the modern economy.
I can imagine.
When you look at the Q1 financial details, you quickly see the immense cost of doing business on a global scale. First, their gross profit margin actually dipped slightly to 78.0%, down from 78.7% in the same period last year.
Here's where it gets really interesting. A company generates $1.65 billion in sales, blows past growth expectations, yet their profit margins actually drop slightly.
Yeah.
And looking even closer at the non-GAAP financial anomalies in the report, the company recorded a massive $123.6 million loss on impairment because one of its VIE investments wasn't recoverable.
Right.
They essentially wrote off over $100 million on a failed investment, and yet the stock market seems to just shrug it off and focus on the raised guidance. How does that financial math work?
This raises an important question about how sophisticated investors evaluate medical technology companies versus, say, traditional retail or software businesses.
Okay, tell me more.
Let's address the gross margin dip first. A 78% gross margin is still incredibly high for a company that actually manufactures physical goods.
True.
The slight drop wasn't because they suddenly started selling their valves at a deep discount. It was primarily driven by a weakening U.S. dollar against foreign currencies, combined with the heavy upfront manufacturing expenses required to spin up new production lines.
Oh, right.
Building the specialized sterile factories required to mass-produce complex new therapies like EVQ and Sapien M3, that puts a heavy drag on margins before those products reach peak sales volume.
You have to spend millions building the highly regulated factory before you can sell a single new valve.
Exactly the case. Now, regarding that $123.6 million loss on impairment, the report specifically notes this was tied to a VIE, a variable interest entity.
What exactly is that?
In the medtech world, massive legacy companies like Edwards frequently use VIEs to invest in smaller, early-stage biotech startups.
Ah, okay.
It is a strategic way to fund bleeding-edge, highly experimental research without bringing the entire operation and its associated liabilities in-house. But it is inherently high risk.
I see.
Sometimes a startup's clinical trials fail, the FDA rejects the technology, and that investment is deemed no longer recoverable.
Which triggers an impairment loss?
Correct. Think of an impairment loss like admitting a very expensive car you bought a few years ago is now completely totaled.
Ouch.
Yeah. The actual cash was spent a long time ago, but today is the day you officially erase its value from your net worth spreadsheet.
Right.
You have to write it down to zero. And the market shrugs it off because you have to view that $123 million write-off in the broader context of their total R&D spend. In Q1 alone, Edwards spent $263 million on research and development.
Oh.
That is 16.0% of their total sales revenue poured directly back into inventing the future. Massive R&D investments, and occasionally eating a nine-figure loss on a risky biotech bet, are simply the lifeblood of staying relevant in medical technology.
The financial anomalies weren't all losses either. I mean, the report also highlights that they recorded a $65.2 million gain on remeasurement of a previously held interest when they acquired another company, which offset some of the pain from the impairment.
Right, it balances out somewhat.
They also paid out $37.1 million in standard litigation expenses. It really paints a picture of a complex, aggressive corporate entity. While the ultimate goal is saving human lives, the daily mechanism is navigating patent lawsuits, strategic acquisitions, foreign currency fluctuations, and massive overhead.
Absolutely.
Just look at their selling, general, and administrative expenses, the SG&A. It came in at $522 million for a single quarter.
And that $522 million isn't just executive salaries and keeping the lights on. In the medical device industry, SG&A includes the highly trained clinical specialists who literally stand in the operating room alongside the surgeons to provide technical guidance during these complex valve deployments.
Oh, wow. I didn't realize that.
Yeah, it funds the massive global infrastructure required to safely distribute sterile biological tissue across international borders. It is a staggering logistical machine.
Oh, it's wild.
But the fact that Edwards could absorb a $123 million VIE impairment, pay out $37 million in litigation, invest a massive $263 million in pure R&D, maintain an army of clinical specialists, and still confidently raise their full-year sales guidance to nearly $7 billion, that speaks volumes about the incredible underlying cash generation power of that core TAVR engine.
It is a phenomenal mechanism. For you listening, this deep dive shows how truly understanding a dense earnings report requires looking past the raw spreadsheet data.
It really does.
It isn't just about crunching adjusted EPS or analyzing slight dips in profit margins. It is a direct window into the immediate future of human healthcare. When we analyze a company like Edwards Lifesciences, we are actually tracing the pipeline of global medical innovation.
Yeah, beautifully said.
We are seeing the massive, capital-intensive financial engines required to continuously invent the technologies that keep our hearts beating longer.
The clinical trial data ultimately drives the financial reality. They are inextricably linked, and you cannot understand the $1.65 billion in revenue without understanding the biological engineering that makes it possible.
So what does this all mean for the future? Earlier, we touched on the early TAVR study and this massive clinical shift toward proactive disease management.
Right.
The medical community is increasingly moving to intervene and repair our bodies before we even show severe, debilitating symptoms. It leaves me with a final thought I want you to consider. If highly capitalized medical tech companies, backed by updated institutional clinical guidelines, are aggressively pushing to intervene in our bodies earlier and earlier in the disease pathway, what does that mean for the fundamental future of our healthcare ecosystems? Will we soon live in a world where complex structural heart procedures, like threading a new valve up through your leg, are treated as routine preventative maintenance, just like getting your teeth cleaned or changing the oil in your car?
It's a fascinating question.
Thank you so much for exploring this earnings report with us today. It is always a privilege to dive into these documents, find the hidden stories, and share them with you. Stay curious, keep looking past the surface of the numbers, and we will catch you on the next one.